This is Las Vegas Real Estate Now, where we bring you the 3 E's: educate, empower, and engage. I'm your host, Harvey Blankfeld, along with our co-host, Shelley Brown, and we've been selling homes here in Southern Nevada since 1988. Shelley and I are also very proud to be part of the Real Estate Radio Network. That is a national network of local real estate professionals delivering timely, balanced truths about local market conditions. We've now been joined by Kari Phillips from Southern Fidelity Mortgage, and Kari's been in the mortgage business for 18 years, and she's the top loan officer at Southern Fidelity Mortgage. 14 of those 18 years have been here in Las Vegas, and she's doing a lot of deals, specializes in VA and FHA financing. Kari, welcome.
Thanks for having me.
Glad to have you back. You know, there's a lot of changes in our market. There's a lot of changes going on in terms of the product mix that's going on out there, and we have a lot of people buying owner-occupied homes again, and we have a lot of military people doing that. So VA becomes a really important program again. One of the cool things about the VA loan is it's assumable. Now, let's explain assumable, Kari.
Okay, so assumable. It means that a client, let's say a client comes in and they do a VA loan at 3.25%.
Wow.
Okay, let's just say that happened.
Okay.
And in 5 years, rates are up to 12%.
Right.
Okay. Mm-hmm. If that VA loan that's on that house, that's attached to the house, can actually be passed on to a new military consumer that wants to purchase their home. So it has to be someone that can qualify for VA financing, someone that has their certification of eligibility. They have to qualify with debt to income ratio and the assets that are required, but they can actually take over that mortgage loan.
Under its terms.
Under its terms at the 3.25%.
Wow.
So that's a huge deal for a seller.
So so a guy has a VA loan and he decides to list at home 5 years from now, and interest rates are 10 or 12%. And I'm his realtor. I'm going to market that. I'm going to say, hey guys, if you're a VA buyer, but they have to be a VA buyer.
They have to be a VA buyer. Okay. You can't take over a VA loan and not be a VA buyer. But
so I'm going to market to those guys. So if you're a VA buyer, we can let you assume this loan. Now, what that means for the seller is that they might get more money for their house than the guy down the street because of that loan, just because of that loan. Mm-hmm. And so there's another reason if you have VA eligibility, there's no reason not to use a VA loan. There's really no reason. The
assumable part of it, I should say this, is there are 2 levels. They're called first tier entitlement and second tier entitlement. And a first tier entitlement means that this person using VA financing can go all the way up to $417,000 in Nevada. The second tier entitlement means that they can go up that high, but they got to bring in a little bit of money down.
Gotcha.
Okay. If a seller lets his first tier entitlement be assumed by that next military person, they've lost their first tier entitlement. Okay. So that's the negative behind it.
So but you can't go borrow it again.
Unless that first tier entitlement is paid off by that new purchaser that came in. So there's a trade-off there. There's a trade-off there, but if I'm the seller, I'm saying if I can get $20,000 more on my house or whatever, and I just have to bring in maybe $12,000 more on the next house, you've just netted $8,000 plus built-in equity on your next new purchase. So it's numbers.
You've been listening to Las Vegas Real Estate Now with hosts Harvey Blankfeld and Shelley Brown. Please tune in every Saturday at 11 a.m. right here on News Talk 720 KDWN.